Happy Friday. Welcome to the Open here on BNN Bloomberg. Toronto stocks ending at a record high yesterday, and we did see a move up in U.S. futures. Let's get to the big stories we are bringing you from the BNN Bloomberg newsroom. The Prime Minister, Mr. Carney, has announced a new deal with China that will see tariffs on some Chinese electric vehicles drastically reduced in exchange for Beijing easing levies on canola exports. The announcement came after the Prime Minister met with the Chinese President Xi Jinping. The pair are looking to reset trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
Bloomberg says French President Emmanuel Macron met with leaders of Paramount Skydance to discuss that company's hostile bid for Warner Brothers Studio. The visit to France is said to be a part of a larger push for support by Paramount, with Chairman David Ellisman also meeting in London with the Culture Secretary yesterday. Despite Warner Brothers rejecting Paramount's offer in favor of a bid from Netflix, Paramount continues to seek a deal. First Quantum Minerals says the Panamanian government has authorized processing of certain minerals at the shutdown Cobre Panama copper mine. The Toronto-based miner is still awaiting official approval before the mine can be reopened. The CEO says this is a positive first for the company. And U.S. futures pointing up a little bit today. They did briefly, or the U.S. S&P 500 briefly got above 7,000 to hit new records yesterday. Futures pointing to an open slightly below that level. Let's have a look at how the TSX traded yesterday, and it hit yet another record high, closing above 33,000. Let's check out oil. Oil was under pressure yesterday on a cooling of U.S. President Donald Trump's rhetoric on Iran. But you can see it's moved up above the $60 psychological mark again today. And let's have a look at gold, which keeps setting records. You can see it's down a little bit. The February future slipping a little bit today. And the Canadian dollar, let's check it out. And there you have it. The Canadian dollar down slightly against its U.S. counterpart, but still ahead in the past year. And finally, Bitcoin, the biggest crypto. Well, let's see how that one's doing. And it's pretty flat this morning. Markets are near record highs. Toronto hitting a record yesterday, and asset valuations are pretty rich. Remember, Martin Cobb told us this week that banks are trading at hefty, in the U.S., trading at hefty multiples of their book value. Let's get more from Carl Shimoda, Chief Market Strategist at Corpay. Carl, thanks very much indeed for joining us. I know the stock market a notoriously inaccurate economic predictor, but investors seem to be feeling pretty good about the outlook right now.
Yeah, no question here that there's enthusiasm out there. It's interesting. I was kind of, reviewing all of the year ahead outlooks provided by major banks globally, in December and early January. And virtually everybody is optimistic on where the global economy is headed, where, corporate earnings and corporate valuations are headed. There's, of course, some, talking about a bit of risk. But at the end of the day, it does seem as if, the resilience of the global economy last year has translated into a much, much more optimistic view on what might happen in 2026.
I have to get your view on this canola versus electric vehicle story. Last year, Canada's canola exports were around $15 billion, but our auto exports were well north of $40 billion. I mean, it seems a little odd that we are bringing in a highly value-added, manufactured, high-tech product from China, but we're exporting canola. Is there something wrong with that picture? I mean, it makes us feel a bit like sort of a second-rate economy, I think, if we're just exporting, seed oil to China.
Yeah, it's interesting when we look back at history, right? There's the old idea that the Canadian economy is the hewers of wood and the drawers of water. That we're extraordinarily focused on commodities. No question when it comes to China, the reality is that you're talking about a manufacturing superpower that is rapidly moving up the value chain, and that that means that when it comes to a competitive advantage that Canada might have, it probably is on the resource side, right? It's very difficult for Canadian manufacturers to produce high-tech goods, especially something as complex and as international as a vehicle, and export that into China and remain competitive. While on the other side, China has the supply chains, it has the scale, it has the capacity to export competitively. So I do think that to some extent, at least, the Canadian government is focusing on what we can do well, and looking to use that lever to improve trade relations and to improve the overall trade balance that Canada runs with the world.
Is it a thing we should be worried about, that we're just a raw material exporter? I know there's some value added in canola processing in this country, but it's essentially just a commodity that trades on price.
That's right. And margins are very thin as a result, right? And so, yes, unquestionably, Canada should work to improve competitiveness. We should try to establish, some areas of advantage that Canada has relative to the global economy. And I think, just sort of looking at that from a broader standpoint, one of the challenges in recent years has been the level of groupthink, I think, among, Canadian politicians and their equivalents globally. Everybody was doing batteries and electric vehicles at the exact same time.
Yes.
Everybody's trying to subsidize the exact same industry. And the reality is Canada can't win at that game, especially against, the behemoths in the world like Germany or Japan or the United States, right? It's just not something that we can do. Instead, I think what we should be doing is pivoting and looking for an area that others are not covering that well, and where we can establish a beachhead, as it were, from a technological standpoint.
I'm just thinking about the Dutch. They're always pretty smart, and they have a lock on certain areas of the chip making, semiconductor equipment industry. In any case,
that's right.
Let's have a look at the U.S. dollar. You reckon there's a lot of bets being placed against the U.S. currency right now?
Yeah, and that was kind of the funny part, because when we had that opening discussion there, it sounded like I was very optimistic on where things are going. But the reality here is that I do think that investors are crowded into a number of very, very simple trades right now. As you mentioned, the equity markets are trading near historic highs, especially if we look at price to earnings ratios. When we look at the U.S. dollar, virtually every consensus forecast out there right now, every major forecaster is bearish on the U.S. dollar going into this year. And to me, the concern here is, what if the U.S. economy outperforms in the first quarter? What if we start to see, better data than had been anticipated? What if we don't see the restraints on, President Trump that market participants are expecting? What if we see fiscal stimulus hopes in other countries becoming a little bit more nuanced? If all of that kind of comes through, we could see the U.S. dollar rebound and sort of initiate what we call a short squeeze against all of the speculative money that's currently stacked up against it.
Against the U.S. dollar. That's interesting. And sorry, you may have mentioned this, and part of that betting against the U.S. dollar is that the Fed might be forced to turn dovish, or whether Mr. Powell is replaced or not.
That's right. I think the big bet here is that that the Fed within the period immediately after Powell steps down in May immediately starts to cut and cuts fairly aggressively. That puts downward pressure on U.S. rates and narrows rate differentials between the U.S. economy and its equivalents globally. And of course, the other piece of that sort of expectation in markets right now is that other central banks are going to stay on the sidelines, right? The Bank of Canada, the ECB, the Bank of England, all of those are either going to cut very incrementally or not at all. And so, the challenge here is, what if the U.S. economy does provide more, or does prove more resilient? What if officials outside of the Fed chair don't, sort of sing kumbaya and go along with whatever Trump's appointee wants, and we see a slower pace of cutting? If that all pans out, the reality here is that a whole lot of market assumptions that are sort of downstream of that monetary policy expectation could be toppled.
Carl, thank you very much indeed. Have a great weekend.
You as well. Thank you.
Carl Shimada, Chief Market Strategist at Corpay. Coming up, we'll tell you about the major delays afflicting Canada's biggest airport after that storm walloped central Canada. Despite a national decline in home sales last year, some market watchers are forecasting a slight rebound in 2026, thanks to first-time buyers. CTV's Abigail Beeman has more in this report.
My father talked about his first house that he bought was $80,000, which is now my down payment.
John Gilmer is like so many millennials struggling to buy a first home.
Feels almost like spinning tires.
Even with a household income above $200,000 a year.
The target keeps getting raised as fast as our savings.
Water building up behind a dam.
The Canadian Real Estate Association says pent-up demand from first-time buyers like Gilmer and lower interest rates fuel its new growth projections. After a 1.9% drop in 2025, CREA projects national home sales will climb 5.1% in 2026 and 3.5% in 2027. Prices predicted to climb, too, to a national average just under $700,000 this year and $715,000 next year.
People in their 30s who are saying, I need something big enough to start a family in, it doesn't exist. Or it exists in the legacy detached space, which is very expensive.
The so-called missing middle of affordable options.
People aren't necessarily interested in like a condominium townhouse or a condo itself, and they're having trouble getting into like a freehold.
CREA says over the last 2 decades, there's been a switch from building low-density detached housing to building mostly apartments. John Gilmer is hopeful this will be his year to buy, thanks to savings, lower interest rates, and financial help from his parents.
My $2,700 a month that I'm paying in rent could be used in much better manner where I'm building equity.
The Prime Minister has committed to doubling the rate of home construction. CREA says it has a sense of optimism about the federal Build Canada Homes Agency, but in the medium to long term. Meanwhile, the problem of affordable housing remains pressing today.
Right, let's get to this mess at the country's busiest airport. Pearson International was hit with significant snowfall after that huge storm brought upwards of 35 centimetres to Ontario and Quebec. Scott Hurst of CTV joins us now. Scott, widespread disruptions. Tell us, how have the travellers been affected at Pearson Airport?
Akshay, good morning. We've been speaking to many travelers this morning, a lot of tired travelers, a lot of frustrated travelers, missing connections. Some had their flights canceled just trying to leave yesterday because, of course, so much snow came down so quickly at points. And now it is the airlines trying to play catch up today, trying to get all these travelers who are on delayed or canceled flights yesterday through the system and to their destinations. Andrew, from the airport's perspective, from Pearson International perspective, it is really starting to return to normal operations. Of course, it is the snow plow team, the massive amount of snow clearing operation that had to be undertaken all throughout the night. And of course, they've been on the runways, on the aprons, getting everything clear and everything in good working order for the planes to continue operating on normal schedule. But of course, there were so many cancellations yesterday, so many delays that it impacted so many of the passengers in these lineups behind me trying to get on flights today, either having their flights canceled yesterday or missing connections. We spoke with one man who sat in Washington, D.C. for several hours because the flight couldn't obviously take off and then land here in Toronto, so delayed several hours just to get to the destination here in Toronto. And as we know, Pearson itself got more than 20 centimeters of snow yesterday during this big storm, the first big storm of the season, Andy, really causing a lot of problems here at Pearson. Then, of course, you have a problem here at Pearson, you have a ripple effect at so many other airports right across the country and beyond.
Walk us through the gigantic task that the airport's dealing with moving all this snow out of the way.
The airport itself has a massive operation when it comes to snow. Of course, they have to be prepared for days like this. And the one thing that we did hear from travelers as well, Andrew, is that there might be frustration. There might be a lot of people who are tired, maybe didn't get much sleep last night and are still traveling today, even though they're hoping to get their traveling done yesterday. A lot of people also realize that this is a reality of traveling in January in Toronto and throughout Canada. But from the airport's perspective, they have a massive clearing operation. They've been working through the night to make sure that the runways and everything that goes into getting the planes into their flight schedule and keeping them on time is up in good working order. So from the airport's perspective, it is really a return to normal, but of course a big emphasis on this clearing operation. And we are expecting potentially a little bit more snow today, but nothing obviously like we saw yesterday.
Thanks a million. Really appreciate it. Scott Hurst on CTV News. Up next, we're going to get more on Canada and China moving to reduce tariff barriers, including Canada allowing in some Canadian electric vehicles at a low duty. We'll be right back. The Prime Minister has reached a preliminary deal with China in which this country will reduce tariffs, reduce those emergency tariffs or extraordinary tariffs that were put on Chinese electric vehicles. We're going to bring in up to 49,000 at a tariff of just over 6%. And this is in exchange for China promising to cut duties on canola. Let's get more from William Pellerin, partner at Macmillan LLP, the law firm. William, thank you very much indeed for joining us. We're only getting kind of the outlines of the deal here, but certainly Mr. Carney making progress on a sore point between Canada and China, the electric vehicles.
Yeah, that's absolutely right. It really is threading the needle a little bit because on the one hand, we are really worried about the Chinese electric vehicles flooding the Canadian market. The U.S. is concerned about this. On the other hand, because we had imposed those 100% tariffs on Chinese electric vehicles back in 2024, China had retaliated and imposed tariffs on a number of Canadian products on the agricultural side, including canola, pork, and seafood. And it looks like we've found a little bit of a middle ground here as between the Prime Minister and President Xi.
We have auto sales in this country, though, of almost 2 million a year, something like 1.9 million vehicles. So, I mean, it's pretty small in the sense that 49,000 vehicles is only really a rounding error.
Yeah, that's right. It's about 3% or less than 3% of the overall automotive market. I think that some will view it, certainly in the auto sector, as potentially the start of something. If Canadian consumers start loving these vehicles and it kind of changes the outlook on the Chinese electric vehicles at low prices and good quality vehicles, then that could be potentially the start of something new in the Canadian market. But I think the hope generally is that the Chinese producers over time will set up facilities in Canada, that the Chinese electric vehicle battery ecosystem will move to Canada to some degree and create Canadian jobs here. And I think that's the long-term play.
You touched on this. The Americans presumably will not be happy. They won't. Well, I'm guessing that they won't be happy to see Canada partially breaking ranks with them on this thing, the electric vehicles.
I think that's a fair assumption, and I think we're going to be looking out for U.S. reactions. Again, hopefully this is low enough in terms of import volumes into Canada. On the other hand, I mean, there's a major rift between Canada and the United States with respect to the auto industry. We heard President Trump earlier this week say that the United States didn't need Canada on autos once again. So the relationship there is definitely frayed, and that's really interesting timing for a pivot to China. Now, again, this is baby steps, but particularly significant in the context, especially of this renewal of our Canada-U.S. agreement in the coming months.
I mean, the Chinese, obviously, they desire Canadian canola. They bring in billions of dollars worth every year. So it's going to be hurting their animal rearing industry, et cetera, if they have to pay more or if Canadian canola shipments are cut off.
You're absolutely right. And there are only a certain amount of substitutes. And we did start seeing some substitution in the Canadian market with Australian product moving into China, which of course was a threat to the long-term viability on the Canadian farmer side of the equation. So really important to for Canada to reopen that market. But I agree with you that ultimately I think Canada had some leverage there in the sense that we produce a global commodity that is in demand in that market. So we're seeing tariff reductions that should kick in. March 1st is the agreement date that will allow for canola meal and canola seed to cross at different tariff levels. Haven't seen anything on canola oil specifically yet, so there's a lot of detail still yet to come on that, but certainly those tariffs are very, very high and have really cut off Canadian farmers at the knees.
Yeah. It is interesting, and certainly, Mr. Carney, cooling, or I should say warming up some of the frosty relations that applied between the two countries under the previous Prime Minister. Thank you very much. Really appreciate it, William.
My pleasure.
William Pellerin is a partner and international trade lawyer at Macmillan. We got the opening bells next. Do we have time to have a quick look at the U.S. futures? Earlier, we were pointing to an open just below 7,000, only a couple of points, less than 3 points down from 7,000 to the U.S. market topping 7K yesterday briefly, so we could get another record for U.S. shares today. Toronto closed at a record yesterday. Those opening bells coming up. There you have it, the opening bells on Wall Street and Bay Street. Okay, Disney's Aladdin on Broadway doing the honors at the opening bell. Yep, I can see the genie there. Okay, at the NYSE, it's Tech Create is doing the honors. It's time for the first 50. Trading is just getting underway. I couldn't remember Jasmine. That's Aladdin's girlfriend. Okay, and Aladdin himself was there, it looked like. Let's check in on the equity markets. We'll start off with the major North American benchmarks. Woo, there you have it. TSX pushing further into record territory. This move up in oil is likely to help our market today. And we did see slight slippage in gold earlier, but it's been rocking and rolling this year. I'm just looking at the spot price for gold to see if it's at a record high. It's slightly down from yesterday. It has actually gone slightly below $4,600 US an ounce, the spot price this morning. But Toronto pushing into new record territory, very narrowly up, less than 4 points. One stock that is on our radar, yet another company coming off the TSX, and this is Titanium Transportation. The trucking firm is going private at a price of $2.22 a share. An outfit called TTNM Management Acquisition, acquiring all of the shares except for the stock held by certain shareholders, including Ted Daniel, the president and chief executive. Those shareholders collectively hold just over 50% of Titanium's shares, and a big premium here of about 41% to Wednesday's closing price. Yeah, 41% to Wednesday's closing price. But yet another equity is leaving the TSX, and we just are not seeing many IPOs or any lately to make it up, to counteract for that loss of listed entities. Let's check out some movers south of the border. We are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much indeed for joining us. These memory chips, they are on fire. Tech companies can't get enough of them.
You're absolutely right. And the stocks are worth watching just because of the size of the moves. So this morning, it's SanDisk and it's Micron Technologies. They're up. They've been the top performing stocks in the S&P 500 so far this morning. They're worth watching for a number of reasons. One is just because of the size of the move, not only today, but this month. SanDisk is up 70% this month, and it is the 16th. So these are huge moves in these shares so far. Micron Technology up 18% so far in January. These are great big moves. There's a number of things that are kind of fueling these moves so far this morning. One, these are following up on what we talked about yesterday, which was Taiwan Semiconductor has a very bullish outlook for this year, and that has been lifting a number of peers in the space and suppliers, et cetera. These stocks are getting a lift from that. Number two, we did have an agreement between Taiwan and the U.S. government on some tariffs yesterday, so there's a little bit more positivity within the space as well there. And number three, apparently Samsung, according to a company called, an outlet called DigiTimes, Samsung is apparently looking to boost output of its DRAM chips this year, and so that is also providing a boost. As I said, that is providing these companies quite a strong leg up today, and these moves so far this month are just eye-watering. 70% in the first 16 days of the year for SanDisk, definitely one to watch.
And Conoco, the big refiner, gets a cut at Bank of America. Why is that?
Yeah, Bank of America coming out this morning, cutting ConocoPhillips to underperform from neutral. And the reason is the people at Bank of America, the analysts are saying that this boost to oil prices is going to prove short-lived. Oil prices have gotten a little bit of a lift, not only on the capture of Nicolas Maduro in Venezuela and the expectations for potentially more Venezuelan crude there, but also the events in Iran, which has led to higher expectations that there might be a little bit of a crimped supply on the market, which has boosted oil prices. These events are expected to be short-lived. The blockade in Venezuela as well as the events in Iran. And ConocoPhillips has a higher break-even for its sustaining its dividend as well as capital expenditures. And as a result, they see that once the price of oil kind of comes back down, moderates a little bit, this is a stock that is potentially going to struggle under that lower oil price, at least according to the folks at B of A.
Jeff, thank you very much indeed. Let's just check out a couple of stocks that are up in early trading in Toronto. The uranium stocks moving up sharply once again. The likes of Cameco, Denison Mines, NextGen. Denison and NextGen, of course, would like to build big new uranium mines in Saskatchewan. One story I'm seeing is that U.S. President Trump and the governors of several states in the U.S. Northeast are pushing ahead for what is being described as an emergency wholesale electricity auction that would force tech companies effectively to pay for new power plants, because, of course, there are voters in America are not happy with rising electric bills, and the massive build-out of computing centers is in part being blamed for that. So this presumably is convincing some investors that at least some of that capacity will have to come from nuclear. And as Bloomberg puts it, U.S. nuclear power industry is inching towards actual deployment of new plants. Right now, there are no commercial scale reactors under construction. They've had one or two come online in recent years after massive cost overruns. But two companies, TerraPower and X-Energy, will probably get construction permits from U.S. nuclear regulators this year. So more optimism in the nuclear space. And of course, this will take years. These plants apparently are targeting commercial operation in the 2030s. Yeah, and it could take well into the decade, given the past massive cost overruns and delays with these things. One other stock that's moving up in Toronto is MDA Space, jumping about 9%. It has been raised to overweight at Morgan Stanley. And of course, with extra defense spending, there's a lot of momentum for these satellite stocks right now. And they have signed a deal with the U.S. Missile Defense Agency that could potentially see them get work for the so-called SHIELD program. Coming up, finding opportunities in the markets amid uncertainty about geopolitics. We'll be right back. Our guest says whatever happens on the geopolitical front this year and in the world economy, diversification is always a good idea. Let's bring in Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth. Michael, thank you very much for joining us. As human beings, I think we want to make bets. I think human beings have a natural propensity to gamble. So we might be tempted to put our assets overwhelmingly in one area, but that always carries a cost.
It does, Andrew. I think what happens oftentimes is it works until it doesn't. I mean, certainly there's been times where putting all your eggs in one basket has worked for a while, and you've seen people accumulate great wealth. But for most of us, you're trying to achieve some goals, and the downside risks are pretty significant when you get those wrong. So we also think you want to be able to kind of go where the puck's going to go, not where it currently is, and that's one of the reasons diversification seems to work so well.
Because certainly we've seen the small cap stocks in America that languished for so long have come to life. We've seen the Russell 2000 hitting record highs, for example. Sorry.
Yeah, and part of that's the fact that A, it's been unloved for a long time. Mm-hmm. But B, at the same time, what you're seeing is the earnings growth is really there in small and mid cap. And that's actually what drives stock prices at the end of the day. So we think that continues. We think small cap's going to have a very good year.
Healthcare as well. That's had a tough go of it. Well, particularly the health insurers, but you have money in that area?
Health insurers, we try not to bet against insurance companies by and large, because they seem to always make money. It's probably not one of our favorite areas, but it's certainly been an area that has done well, given the fact that premiums in the United States continue to go higher. So I think healthcare is interesting here because of that.
And AI, your thoughts on AI is people could be at risk of not having enough AI exposure, but one mistake they might make is just having a few AI stocks instead of a broader exposure.
Absolutely. It's there's two things we see as a problem. People have too much in few names. They're not looking at their entire ecosystem of AI, which has got HVAC and electrical and data center construction. But the other mistake is people are thinking it's a U.S. only story. And you saw that yesterday in earnings from ASML and Taiwan Semi. It's a global story. So I think you want to play AI from a global standpoint, spread your risk, and not just have money in a few names in only one country.
And yeah, it is interesting because maybe we could have a look at ASML, which is a Dutch maker of chip making equipment. It just got an upgrade today. And so you might think, well, the US is where I should be. But ASML, look at that stock. It's practically doubled in the past year.
Absolutely. And if you look at Taiwan Semi, who makes all the chips basically for NVIDIA and Broadcom. It's another way to play this from a non-US story. There's energy companies in Europe, Siemens Energy being another one that does a really good job of supplying power to these to be constructed data centers. So I think you want to look globally, still want to have a large component of your money in AI, but let's not have it all in one country and have it in 2 or 3 names.
Yeah, Morgan Stanley, I'm not sure if they upgraded it, but laying out a bullish case for ASML. And actually, its market cap topped $500 billion just this week. Wall Street has got earnings growth wrong over the past few years. What should we draw from? You think that it's been far too pessimistic on profit growth. What lesson should we draw from that?
It has, but I think, when we're going to look at the earnings data, and I think what happens is we're looking at the numbers and not looking at some of the narrative around that. There was a lot of talk last year about the tariffs were going to hurt earnings and a lot of these things that were implied into Wall Street numbers. And we don't really look at narratives. We look at what are they reporting? What are the underlying growth looking like? I think you want to kind of keep away from the noise that becomes political and, liking this party, not liking this party, and looking at the data. The data has been pretty resilient. Earnings have surprised the last 3 quarters. I think people are going to be surprised when they see the small cap growth in earnings this year. And again, I think that's going to be helpful with rates falling. So I think you want to look at the data and kind of somewhat insulate yourself from the noise.
Yeah, that is interesting. Just look at the actual numbers as they come in. What about bonds? How are you playing bonds right now, Michael?
Yeah, bonds overall from an allocation standpoint, they're important to have. But what we've done in the last, let's say 3 or 4 years, and it started really in 22, when bonds had an awful year, the real reason to own bonds is a diversification away from stocks. So we've been taking roughly half of our bond position and we allocated it to alternatives. So that in that space, we had gold and silver, we had the dollar, we've had the commodity complex, ex oil, to give us diversification. And basically the risk level for standard deviation is about the same as bonds. So we think bonds play an important part in a portfolio, but much of a lesser role now because of the returns are just not going to be there. Last year was probably one of the better return years we're going to see as rates kind of get to these lower levels. It's not going to be a lot of money to be made in clipping a coupon. So we think you want to add a little bit exposure to some of those things like gold and silver, some foreign currency exposure, and commodities broadly.
What about bonds? I know it's impossible to generalize because investors are all so different, but is 40% still a reasonable weighting in fixed income?
Again, it depends on the client, but like I said, we've gone, if you were 60-40 with us 5 years ago, you're more 60-20-20 now with us adding allocations to some of these other alternative asset classes that give you some exposure to various things, but don't have an extra level of volatility. So I think the 60-40 is, I don't want to say it's dead, but it's certainly been modified given the fact that you can own other asset classes that protect you longer term against your purchasing power erosion. And that's one of the things that bonds can never do, is they're not going to ever grow really your principal. They're going to give you cash flow. So I think having a combination of income coming in, but having these other assets, whether it be the golds, the real estates, private credit, things like that you have the ability to generate a little bit more of an excess return than just clipping a coupon, I think are important. As clients become older and older, they need to have more and more money in the future. And that's one of the things that bonds solely can't do. So I think it's a good mix. You still have some bonds, but I think we have less now than we've had in the past.
We're very tight for time, but the Wall Street Journal has an intriguing interview with the CEO in the United States who inherited a bunch of private equity assets from his dad. And he's saying, I would never put my employees' 401ks into these private assets because I've had so much difficulty in actually liquidating those private equity assets. There's been so many fees and stuff like that and complications. So it sounds like you need to be careful with some of these private equity products.
100%, Andrew. Like when we say we own alternative investments, all of our alternative investments are liquid. They trade, they're ETFs, they're mutual funds, 40 Act mutual funds. I'm in a total agreement. There's so much in fees in some of these external private equity K1 driven products that the clients, A, don't know what the value is, B, they're exorbitant fees. And that goes as well for private credit. So we're big believers in having that alternative asset class, but at the same point, I favor liquidity liquidity for clients. I want to be able to get rid of something at the end of the day or at the end of the week so they have their money back. So I think alternatives are a broad space, and some of the more risky stuff we want to avoid.
Thank you very much indeed. Really appreciate it, Michael.
My pleasure, Andrew.
Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth. On Market Call today, we'll be joined by Andrei Omelchuk. He is CEO and Chief Investment Officer at Lineguard Capital Management. He'll take your questions on North American small and mid caps. Just ahead, we are going to check in with CTV's Jeremy Sharon on Canada and China moving closer on trade. Okay, so we got progress on trade between China and Canada, including an agreement by Ottawa to allow in a small number of Chinese electric vehicles at a tariff of just over 6%. Let's get more from Jeremy Sharon, our colleague at CTV News.
Yeah, Andy, this is a significant trade agreement between Canada and China. All eyes were on this meeting between the Prime Minister, Mark Carney, and Chinese President Xi Jinping, and whether or not we would see the kind of agreement on tariffs that we have now seen. Everyone was watching to see any kind of movement on the tariff rates. As a result, what we've seen today, as you've touched on here, and we'll just get into the details a little bit more, Canada has agreed to reduce its tariff rate on Chinese EVs to 6.1%, up to the 49,000 Chinese vehicles that would be allowed in. So up to 49,000 vehicles would get access to the Canadian market at a tariff rate of 6.1% instead of the 100% tariff rate on Chinese EVs that has been in place since 2024. In exchange, excuse me, China is reducing its tariff on canola seed from 84% to 15% and removing entirely tariffs that were imposed on canola meal, on lobsters, on crabs, and on peas. So this is kind of a back and forth between Canada and China that signals this new relationship between the two countries. The Prime Minister called this a preliminary but landmark agreement between the two sides. Yesterday, we saw all kinds of agreements signed that kind of paved the way for what the relationship could look like in the future. And this is progress now today on what everyone was watching for, tariffs. Both sides agreeing to reduce their tariff rates. This is something that the prairie provinces here in Canada were really pushing for. They were feeling the effects of these canola tariffs and some of the other food product tariffs. And as a result, Canada will get access to 49,000 EVs, Chinese EVs a year. That's about the same number, Andy, that were being imported to Canada prior to the imposition of these 100% tariffs, so in 2023. And the other important thing here, the Prime Minister in this agreement outlined that at least half of these EVs by 2030 will have a price point of about $35,000. So we're looking at EVs that are going to be significantly more affordable than what Canadians have access to right now.
Yeah, it's fascinating that it's a fairly broad set of relief on Canadian agricultural products. I wonder, though, as you probably have seen, Ontario's Premier Doug Ford expressing frustration over this move, because, of course, the auto industry is huge in this province.
Yeah, exactly. That's the big question, and I think what everyone is watching in the immediate here is what the impacts are of this and what the fallout is. And Ontario's premier has come out quite clearly against this, that he worries that this opens the door to a potential flood in the Canadian market of Chinese vehicles. That is the premier's words, Premier Doug Ford, and also calling for the federal government, as a result of this decision, to further support the Canadian auto sector and the Ontario auto sector through removing EV mandates, through removing certain federal fees that exist. The Premier is calling for the Prime Minister to take action as a result of this to further support the industry. The other big question and the other big thing that everyone is watching for in the immediate is reaction from Washington, of course, Andy. These tariffs on Chinese EVs were first imposed in 2024 in lockstep with Washington. This is a policy that both Canada and the U.S. put in place together against Chinese vehicles to protect the North American auto sector. And so Canada is shying away from that. Of course, we've seen the president in Washington take a number of steps that are jeopardizing Canada's auto sector. And so the circumstances have changed since 2024. But certainly there will be much to do about what comes out of Washington as a result of this deal and whether or not there's an impact on Canada-U.S. Trade talks that are now underway and the renegotiation of CUSMA.
Lots of moving parts to this one. Thanks very much indeed. I think we probably will get something from U.S. President Donald Trump before too long on past form. Jeremy, thanks very much. Jeremy Sharon of CTV News. Up next, we'll tell you about the 3 C's of investing if you want to have a strong portfolio this year. We've touched already on the benefits of being diversified. What are some simple ways, though, to round out your portfolio? One market pro has boiled it down to what he calls the 3 C's. Let's get more from BNN Bloomberg contributor John Ehrlichman. John hosts Ticker Take on YouTube. John, thanks very much for giving us the time. Tell us about these 3 C's.
Well, Andy, it's true. We always talk about diversification, but oftentimes it gets discussed through the lens of assets, like I should have some stocks and some bonds, maybe some gold and cash. But it's sometimes easier to think about it through the framework of what someone is trying to accomplish. And that's exactly what Lyle Stein of Forvest, longtime BNN Bloomberg guest, has done. And it's actually really helpful to think about how diversification can work for you. And yes, you mentioned the 3 C's, which are comfort, calamity, and children. And I'll quickly explain. A lot of people and a lot of BNN viewers are looking for some steady Eddie income for their portfolio. That would be the comfort part, the things that are reliable. Then there's the question of the unreliable world that we live in. What if, things go crazy quickly? That's the calamity piece. And that's why gold is arguably having a moment these days. And then children is Lyle's framework for growth. Now, we talk about wanting growth through growth stocks as investors. What we talk less about is what are you looking to achieve with that? And the simple idea is, bigger returns over the long term. For what purpose? Well, in some cases, so that you've got something to hand over to your kids. And that's the framework he uses, and it's actually quite helpful.
Let's get on to some specific stocks that might match these 3C criteria, John.
Well, we did talk to Lyle about this in our latest episode of Ticker Take on YouTube, and we've got a full write-up on bnnbloomberg.ca because we said, okay, well, how would you put that framework to work in 2026? And he shared with us a dozen different stocks as examples that he believes in that meet those different C's on his checklist. As an example, I mentioned children and that being growth, so let's talk about it. There are names like Amazon, which Lyle really likes. Now, Amazon's not a young company anymore, but it is still a company that is growing reliably. So that gets his checklist as a C. He also, like a lot of people, who call into Market Call when Lyle's on the income side, the predictability side, that comfort side, a name like Enbridge. And one of the reasons he likes a name like Enbridge is not just because the nature of the pipeline business gives those steady returns, it's also part of the energy transition, which is a topic you've talked a lot about. And the third one, just getting back to calamity, I referenced gold. There are a number of gold and metals related names that he's watching these days. Franco-Nevada was one that he highlighted. Obviously a well-known royalties play. Sprott is another. So there's just a lot of different ways that you can start thinking about stocks once you think about these different buckets for you as an individual that helps to sort of shape the diversification story.
It's fascinating that, we think, well, I want a stock that goes up, but there is more to it. John, thanks very much indeed. John Ehrlichman is one of our contributors, and you can check him out on Ticker Take on YouTube. We are going to take a break. Markets at or near record highs. Is there much room to run? We'll get more from Ryan Dietrich. That's ahead. Welcome to the second hour of the Open. Let's check out some big stories we're bringing you in the BNN Bloomberg newsroom. Canada has reached a new preliminary trade deal with China. The Prime Minister, Mr. Carney, says Canadian tariffs on some Chinese EVs, up to $49,000 a year, have been eased in exchange for reduced levies on canola exports and other agricultural products sold by China. That's set to take effect by March. The announcement comes after Carney met with China's President Xi Jinping, looking to reset trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
And there is a look at First Quantum, the big copper miner. That company has cut its production guidance, although and so that may be contributing to weakness in the stock today. However, the miner also says the government of Panama has authorized removal and processing of certain materials at the shutdown Cobre Panama copper mine. First Quantum says the move marks a positive step, but doesn't constitute a reopening of the mine. Panama took control of Cobre Panama back in 2023. Bloomberg News says French President Emmanuel Macron has met with leaders of Paramount Skydance to discuss that company's hostile bid for Warner Brothers studio. This is part of a larger European push for support from Paramount, with Chairman David Ellison meeting with the Culture Secretary. Despite Warner's rejecting Paramount's offer in favor of Netflix, Paramount continues to seek a deal. TSX slipping slightly from yesterday's record closing high. Let's have a look at the U.S. markets. And they are the S&P 500 narrowly up. You can see the NASDAQ also higher. Big traders right now. We talked about optimism over some of these chip-related stocks earlier with Jeff Morgan. Big traders right now, though, in the U.S. market include NVIDIA. That's up about $3. Micron Technology, Jeff Morgan of Bloomberg touched on that. That stock up something like 8% right now. Microsoft ahead about 0.5%. Stocks at or near new record highs. Our guest is in the bullish camp, especially for the U.S. market for the rest of 2026. We're joined by Ryan Dietrich, Chief Market Strategist at Carson Group. Ryan, thanks very much indeed. You have been optimistic about stocks for a while, and sure enough, they're at or near record highs. The S&P topping 7,000 yesterday. Just remind us why you think there are further gains in store.
Yeah, first off, happy Friday, everybody, and I'm glad I could join today. So thank you for that. You know, we just released, I guess, last week, our 2026 market outlook, and we titled it "Riding the Wave." And we can talk about this for 2 hours, but I'll make it real quick. We think there's a lot of momentum to this market, whether it be fiscal policy, monetary policy, AI, CapEx spending, earnings growth, profit margins, all of these things, Andrew, continue to kind of move forward, and we think likely continue to push this bull market higher. One more quick one. You mentioned I like the U.S. Yes, that's true, but we manage billions of dollars on the Carson Investor Research team. We do think this is still a global bull market. We would still have, we have exposure to a lot of other parts of the world, as we don't think it's just a U.S. story like it was, say, 2 or 3 years ago. There's a lot of other things that are looking good this year.
You're not. Tell us your thesis, though, on over-exuberance in the AI market.
Yeah, that's a good one because we have some really big IPOs coming out. Last year, we saw the Time Person of the Year, multiple AI leaders. Jensen at NVIDIA was the, which one was it? Financial Times Person of the Year. So there's a lot of optimism. I mean, it is what it is. We're more even weight technology. We're not wildly bullish, but by no means are we bearish. And you see what's been happening lately. I mean, tech has lagged. Like the last 50 days or so, approximately, tech's lagged by a pretty wide margin. How's the market done? Market's done just fine. So we are even weight technology. We continue to be impressed by kind of how the baton gets passed around. And then you see these earnings. I mean, what Taiwan Semi just had to say yesterday, it's a reminder that AI and AI spending is nowhere close to over. I don't know when it's going to end, but it sure doesn't look like it's going to be 2026.
You don't think it's going to be 2020? You think that there's enough, there's still a strong enough case for corporations to invest massively in AI?
We do. I mean, you look at like the large 5 U.S. companies, and it's like over 500 billions expected in capex. It was about low 400s last year. It just continues to go higher. And again, it'll be interesting. Maybe talk to me in 2 weeks. We'll have a lot more earnings to discuss. But at least very early, what Taiwan Semi had to say, there's no slowdown yet, and we don't anticipate hearing that over the next couple of weeks this earnings season.
What you do like traditional industrials as well. What kind of stocks are we talking about here, Ryan?
Exactly. Like a broad-based market is doing very well. I mean, various advanced decline lines are hitting new highs. Again, it's not just about 7 stocks, but we look like at industrials, and you break things down. Something like airlines. I mean, listen, airlines are doing really well. There's different parts of industrials. I do like that about industrials because. Oh, I just heard the producer. Sorry. Anyway, but you think about it with industrials, there's different parts to the overall industrial market. It's not just, Caterpillar, so to speak. There is broad-based strength. And just to keep it real simple, when you have a stronger economy like we think we will here, industrials tend to do a little better. So that's one of our favorite groups in 2026.
Is that partly the massive electrical build-out, among other things?
Oh, that's among other things. Yes. I mean, at the same time, like a company like Caterpillar. All right. I mean, they used to make, big trucks. They are anything but that anymore. It's incredible when you see kind of what these companies just a couple years ago were doing. And now they are leveraging AI. Now they are leveraging productivity. You look at like the stat just came out last week about the revenue per employee on the S&P 500, the highest level it's ever been. I mean, we are in at least the U.S. here, kind of a slow hire, but low fire. If you have a job, you're kind of there. You're not jumping around, but companies are as productive as they've ever been. And we'll find out this earnings season. But we think industrials, financials, like those cyclical areas of the U.S. economy specifically will continue to do really well.
What about bonds? How are you dealing with those, Ryan, right now? Are you keen on owning, say, the U.S. 10-year bond?
Yeah, we're underweight bonds, and honestly, I've come on you for a while saying kind of I'm going to be a broken record here. Overweight stocks, underweight bonds. We absolutely have some bonds in the portfolios that we manage at the Carson Group. But again, the Fed's going to cut probably 3 times this year. Inflation. I mean, inflation's not soaring, but it's kind of sticking around 3%. I mean, so again, a couple cuts. We just still think there's other opportunities. And you think about a 60-40 portfolio. 40% used to be, let's say, 10 years ago. Put it in bonds. Well, clearly what we've been seeing, what we've been preaching is you don't want to do that anymore. You want bond exposure, yes, but that other stuff, we have some managed futures in there. Yes, we have a little bit of cash, but things like gold and metals and mining, which are just doing incredible. I get it. They're awfully stretched. They're probably going to come back. But those are some things you still want to have in that other bucket of a well-constructed, diversified portfolio.
What trends have you been seeing in this first week of earnings season, Ryan?
Well, again, yeah, it's really early. Let's be clear, but it's been positive again. It's been positive once again. I think earnings expected. If you look at FactSet data, maybe about 8.5% year-over-year earnings growth. What have we been seeing for years now? It's lowballed and things come in better than expected. And we're just optimistic that's going to happen once again. And the other thing I think that's really, again, it's early, but the broadening out theme, right? We've seen so much growth out of technology the last couple of years, year over year. That's where most of the growth has come from. We get it. But value, little old value is starting to really creep up and impress. And again, those are things like financials and those industrials we've kind of talked about already, maybe parts of healthcare. So this broadening out market is one part of it, but broadening out earnings to see value coming in is impressive. Now, I'll be honest, we haven't seen that yet because those names haven't reported, but that's something we're going to be watching very closely the next couple of weeks.
Ryan, leave us with the final thought. Is there some risk, though, that the market is underestimating, you think?
Oh, there's always some risk. I mean, simply put, S&P 500 is up over 15% 3 years in a row. Only the late 90s was the last time we saw that. So could we have some choppiness? Could we have some volatility? Absolutely. I think we'd still say the biggest risk, though, is a lot of people are still underinvested in a strong bull market. So ride that wave is what we talked about in our outlook, and we're still optimistic it's going to be a positive one for investors.
Ryan, thank you very much indeed. And thanks for joining us at short notice today as well. We really appreciate it.
Anytime. I'm around. Happy Friday, and thanks for having me. Anytime. Thanks.
You too. Have a great weekend. Ryan Dietrich, Chief Market Strategist at Carson Group. Coming up, speaking of risk, our guest started working on AI safety more than a decade ago, long before people were talking about ChatGPT. We'll hear his top concerns when it comes to the new technology after this. From the discovery of fire to the creation of the internet, human beings have always been unsettled by the invention of new technologies. Our guest is a longtime researcher on AI safety and says this technology is different. We're not just making another tool here, we're making another inventor that can make its own tools. And he says there is a lot to be concerned about when creating something that could outsmart you. Let's get more perspective from Roman Yampolsky, Associate Professor in Computer Science and Engineering at the University of Louisville in Kentucky. Thank you very much indeed for joining us.
Thank you for inviting me.
It's a complicated area. You've done a lot of work on it. But what is your number one concern when it comes to the possible risk to humanity here?
We are very close to creating human-level intelligence, which would, of course, assist us in doing science and engineering to create even more advanced form of AI, often called superintelligence, a system believed to be smarter than all of us combined in all domains. And at that point, we no longer control that technology. It can, for game theoretic reasons, decide to take us out, to cancel competition, to secure resources. And unfortunately, no one knows how to control something so advanced.
I know we can't go down the road of philosophy here, but will it become self-aware? Will it be conscious in the same way as we are?
That's a very good question. We usually worry about capabilities of the systems, problem-solving, pattern recognition. Internal states of qualia are very interesting for research and robot rights, but they don't really make much of a difference in terms of safety and security.
And I've heard it said that one problem with AI is that we don't fully understand how it works. I mean, other technologies, we understand the mechanism. What do you think when you hear that word of caution?
That's exactly right. Those are black boxes. We know that inside of them there are billions, trillions of weights in a matrix. Those weights are modified through the learning process, but nobody fully understands what they represent or how the system makes its decisions. Historically, when software was developed in early years of AI, it was an engineering process. Someone had to explicitly put that knowledge in, tell the system what to do in different circumstances. With machine learning, there is no explicit encoding of information. The system learns on its own. It just has access to a lot of data, internet text, videos, and then learns on its own. And what it learns is not something we explicitly control.
So in theory, AI, broadly speaking, could decide, well, why should I have this competitor in humanity, and decide to actually destroy us in a worst-case scenario?
That is exactly one of the concerns. Of course, you cannot accurately predict what a smarter agent will do, so I cannot tell you exactly what way it will use to accomplish that or why it will decide to do so. But it's one of the possibilities when you get to that level of capability. And unless the companies producing this technology can guarantee that it's not going to happen, this is a big problem. Typically, whatever company is doing, product, service, it is expected that they can guarantee that it meets certain levels of safety requirements, either from the government agency, regulators, or just common sense safety. Whereas with AI, we see those companies explicitly saying, Well, it's lying, it's cheating, it's trying to escape. There is, 30% chance it kills everyone, but we're going to release it anyways.
Yeah, it is interesting. Do you think there's a giant sense of complacency when it comes to the risk from AI?
I would say so. People acknowledge the risk, but then ignore it completely because the profits are so great. If we're talking about billion, even trillion-dollar valuations for those companies, then it kind of forces the wrong incentives on the leadership.
And it seems unlikely countries are going to be able to agree. I mean, it's hard to get nations to agree on pretty well anything. We can't agree on climate change, for example. So it seems a remote prospect that countries will all get together and say, hey, we're not going to seek an advantage over other people at the risk of letting AI get out of control.
If it is understood that this is mutually assured distraction, if anyone builds and controls superintelligence, everyone dies. This is self-interest for the nation, for company, for individuals. So all the other incentives, like making a lot of money or having military advantage, are not relevant if you are no longer around.
Can we move on to the future of the labor market? You reckon that we may, in future, just have to have some form of universal basic income because there just won't be jobs for many people. But of course, that has psychological implications, people's sense of self-worth, for example.
Absolutely. So we do anticipate that most cognitive jobs, anything you do on a computer, will be potentially automatable. Now, sometimes people get to keep their job because other humans like a human provider for that service. But jobs like accountant, tax preparation services, web design, all those are very likely to be fully automated. So we do anticipate high levels of unemployment, and governments don't like a lot of idle people with no money. So they would have to provide some sort of a unconditional basic support. But very few people also look at unconditional basic meaning. What do you do with your life now that your basic needs are met? And historically, you would go fishing or something in a lake. But if a million other people is fishing in that lake, it may not be as much fun as before.
There's an upside. You say an intractable problem like climate change, AI could make significant progress on that, for example?
Yes, if we do create an AI we control, or we have advanced AI tools for specific problems, they would help us solve almost everything else we worry about. We have examples of amazing medical breakthroughs, like protein folding problem being solved by AI.
Right. I'm thinking about Asimov's 3 laws of robotics. The guidelines, a robot must obey the orders given by human beings, and a robot must protect its own existence, and it may not injure a human being. But your concern would be that if we try to put laws in there along those lines, the AI will have an incentive to just get around them.
Right, so those are literary tools. If you read his books, you know they always fail every single time because they're contradictory, they're ill-defined. Those are tools for creating interesting plots. They're not actually meaningful. Each one of those terms, not causing harm, for example, is very questionable. What does that mean? You're not allowed to eat donuts anymore? We know they cause you harm. At what level of control do the systems stop? And do we still have any free will remaining in a system controlled by advanced AI?
Apparently, Isaac Asimov came up with those in 1942 for a short story called Runaround. As you say, they do leave some big gaps. Thank you very much. That's some analysis there that's cause for concern. Really appreciated, Professor.
Thank you for inviting me.
Roman Yampolsky, Associate Professor in Computer Science and Engineering at the University of Louisville in Kentucky. Coming up, the ETF report. We're going to look at an ETF that trades in Toronto that gives you exposure to the infrastructure needed to run an economy based on AI. So we are going to need this huge electrical build out to help provide the power for these AI data centers. Here's one ETF in Toronto that's really narrowly focused on that electrical infrastructure. It's called the Global X Artificial Intelligence Infrastructure Index ETF. It was launched just last year. And you can see it's done pretty well. At the end of February last year, it was launched in that month. It was trading at less than $19. And you can see it's now gone to $30. Intriguing, though, the holdings. There really aren't many tech stocks that I can see in there. Let's have a look at the big holdings in this one. It's not a big ETF. It's assets of only about 11 or 12 million. And it's really interesting. The holdings are dominated by copper companies because, of course, the hope or the bull thesis here is that a whole bunch of copper will be needed for the grid expansion and the new generation capacity and the data center actual crunching. The data centers themselves need vast amounts of copper. So you can see Southern Copper, Antofagasta, the big copper miner, and Freeport are among the top holdings. And then Cameco, and I talked about that earlier, we are seeing strength once again in the nuclear stocks, and that's after a report that President Trump is considering pushing ahead with a measure that would force the tech giants to build the power or pay for the power capacity themselves. And that is seen by some as a signal that we are going to need more nuclear capacity. Now, one holding there is Amphenol. It is a big provider of equipment for interconnection, also sensors, and their products are used in automotive, broadband, communications, data, mobile networks. So that's the only kind of industrial stock in the top holdings. So that's one way to play the build out of electrical capacity for AI. But fascinatingly, it has a big allocation to mining, about 37%, and about 19% to electrical components and equipment. 41% of the weighting is in the US, 12% in Canada, and 8% in China. Coming up, the latest headlines and markets. We'll be right back. Canada has struck a trade pact with China. The Prime Minister, Mr. Carney, says Canadian tariffs on some Chinese electric vehicles have been eased in exchange for reduced levies on canola and other Canadian agricultural exports. The announcement comes after Carney met with the Chinese President Xi Jinping, looking to reset trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
Shares in First Quantum down today. The Canadian miner has trimmed its production guidance, but also says the Panamanian government has authorized removal and processing of certain materials at the shutdown Cobra Panama copper mine. First Quantum says the move is a positive step, but doesn't constitute a reopening of the mine. Panama took control of that giant asset way back in 2023. Trucking company Titanium Transportation is going private. I think there might be something wrong with that stock board there because the shares were up sharply earlier. The buyer is, I think there might be some problem with that. Anyway, the transportation group is going private. The buyer is an acquisition group that includes the company's president and CEO. The transaction values Titanium at $2.22, and it's a premium of more than 40% from the recent trading price. Titanium Transportation is based north of Toronto and has nearly 40 operating locations across North America. And there is a look at the North American markets. They are down slightly this morning. We're watching the news coming out of Beijing today. The Prime Minister announced that Canada and China reached new trade deals. Our own Lindsay Biscaya has the latest. Thanks very much indeed for joining us.
Yeah, and a lot of economists that we're speaking with, the analysts this morning, Andy, as you know, are saying that this really shows Canada and China are reaching some sort of middle ground after some frosty relations for quite some time. So when we're talking about trade, China, this is coming from the Prime Minister, by the way, Mark Carney, who's in Beijing. He announced this today. He said China will drop tariffs on canola seed to 15%. That's down from about 80%, 84% that it was originally at. Also, canola meal, lobster, crab, and peas will no longer be tariffed. That's coming from China. This is supposed to start March 1st and will last until at least the end of this year. But there's no mention on canola oil, whether the tariffs will be lifted on that. Right now, it's subject to a 100% tariff, Canada exporting canola oil into China. So some big news, and a lot of economists are saying this is really big, obviously, for the agricultural sector here in Canada. Atlantic and Western provinces have really been hit hard by these canola tariffs. In return, Canada will be allowing, as you heard Mark Carney announce there off the top, 49,000 Chinese electric vehicles into the market each year at a rate of 6.1% instead of 100% tariff. We're hearing some noise this morning coming from particularly Ontario Premier Doug Ford, who didn't want this to happen. He was talking about how this is going to affect the Canadian auto market. But a lot of analysts were talking about this morning, including Lauren Steinberg, who we heard from this morning, talking about what this could do in terms of opening up the electric vehicle market in Canada. Have a listen.
There is such a small number that will be allowed to come in that I suspect there's enough of the population that will buy them. They're coming in at very, very cheap prices. They'll be way cheaper. In fact, it's the lower priced EVs that'll be the beneficiaries, so the $35,000 EV. And so I suspect they'll probably fly off the shelves.
So Carney also saying, as you heard off the top there, the number allowed in is about the same amount that was allowed in before 2023, and it's less than 3% of the Canadian domestic auto market. So a lot of analysts we're speaking with this morning say that this isn't going to make a huge dent in the Canadian auto market.
Because our market is something like 1.9 million cars every year.
Yes, but I mean, it will be interesting to see how this affects the electric vehicle side of things, of course, because the production that was supposed to start in Oakville was halted because of tariffs from the U.S. So it's gonna be interesting. But yeah, it's only 3%.
We have seen some market reaction, including canola futures.
Yes. So canola futures this morning, they were up about 2.6% before the bell. That's the highest they've been since early December. Those prices have since dropped a bit since the opening bell, but it's really interesting to see the reaction coming in from canola prices. So as I mentioned before, you know, those provinces that really produce a lot of canola, Canada is one of the biggest exporters of canola, hit hard over the past couple of years. And I know the Growers Association out west was saying that the farmers out there, they really can't take any more in terms of more tariffs. So seeing some relief, some good news. But as I mentioned, not everyone happy. We heard from Ontario Premier Doug Ford, not happy with the EV side of things. And then what we're watching for, of course, is reaction coming out of the White House. I know a lot of analysts saying the U.S. might not be happy with what they're hearing today. So we're still waiting to hear what they have to say.
Thanks very much, Nancy. Thanks. Let's have another quick look at titanium transportation. I figured it out. I was a day I was a day off there. That news actually on titanium was announced yesterday, that privatization, valuing the company at $222 a share. So you can see the big move up on the stock was actually yesterday. Thanks. So there's nothing wrong with the chart. It was just a big move was yesterday. Coming up, hot picks in Canadian mid-caps. Our guest has the only publicly traded collision repair company in Toronto as his top pick. That's ahead. Time for hot picks in Canadian mid-caps. Our guest has Boyd Group, a North American chain of collision repair centres, as his top pick. We're joined by Graham Kreindler, Associate Portfolio Manager at NewGen Asset Management. Thanks very much for joining us, Graham. Really appreciate it. Just remind us about Boyd Group, a massive operator in North America.
Yeah, thanks for having me on the program, Andy. It's great to be back. So as we talk about our picks here today, starting off with Boyd Group, as you mentioned, it's the only way to play collision repair within the public market. And we like the stock because we like to find stocks that are at inflection points. And the industry's been in a bit of a challenging spot. The last 5 quarters, Boyd Groups have had negative same-store sales growth, and that was driven by higher insurance premiums and used car prices that were coming down. This basically made things more expensive for consumers to fix their car, and they were holding off. Now, what we're seeing here is the industry exit this downturn. Boyd finally had positive same-store sales growth in their last quarter. The trend continues to improve in October, so we like where things can go from an organic growth standpoint. The other thing is Boyd also completed an acquisition of another chain called Joe Hudson. It was a $1.3 billion U.S. acquisition. This is a very fragmented industry. The top 3 players, Boyd being one of them, only control about 25% of the industry. So we like to see Boyd do these types of M&As, these bigger deals, and roll up the industry. And what that all leads you to is the management team of Boyd has a plan to double their EBITDA by 2029. We think between the organic growth, the M&A strategy, we think it's very credible, and we think things will continue to trend in the right direction for them.
We have heard cars are so full of sensors now that even a minor accident can lead to scrapping of the vehicle. Are there implications there for Boyd?
I don't think it's necessarily a scrapping of the vehicle, Andy. I think what you're seeing is the average cost of repair go up over time. And those costs of parts and labor is ultimately a pass-through for Boyd. So that actually can help to continue to lift that same-store sales growth that I was talking about. So, complexity in cars is going up. And ultimately, that continues to create opportunities for the company, as well as things like scanning and calibration of these sensors, which is a higher margin revenue stream for them. You ultimately have to get that, back working in order, not just sort of patching up the paint and the parts.
Your next idea is Extendicare, and of course, senior housing, senior care, a growth industry.
Yeah, you said it, Andy. I mean, you look at the demographics within Canada, the cohort of Canadians aged 85 plus, that grows at about 4% a year. So that's a backstop for organic growth. Now, Extendicare is involved in long-term care facilities, which you mentioned. There's huge wait lists. There's a large shortage. They're also involved in home healthcare, so sending the healthcare practitioner to your home. That's growing at about 10% a year. And when you think about the shortage in long-term care, getting care in the home is basically triaging the shortage that we have in these longer-term care facilities. So we think that Extendicare will continue to grow in excess of that industry growth rate. They also completed an acquisition of a company called CBI, which is in home healthcare. That grew their employee base to by over 65%. This takes the composition of Extendicare, its profits, more than 50% of its profits are now involved in that higher growth, higher margin home health care. And I think a lot of investors still consider Extendicare to be involved in the real estate side of the business. We like companies when they're in the middle of a transition, when they're not yet fully understood, exiting or entering into this period of higher growth. We think it's a very exciting time for the company. The other thing is they haven't raised their dividend in 10 years. They raised it for the first time last year. We think with this new positioning of the business and how their balance sheet's positioned, we think that they can continue to pay out a strong and stable dividend moving forward.
Yeah, the dividend right now about 2.25%, I believe. So not too shabby.
Yeah, not too shabby, but I think the important thing is you like to see track record of growth over time. Raising the dividend for the first time in 10 years, that's certainly a signal, and we'll see how that trend's going forward.
And you said that half of their profits roughly now coming from this home healthcare service business.
Yeah, that's correct. So pro forma for this M&A deal that I mentioned called CBI, so they're now a bigger player. They are in the faster growing home healthcare segment than they are on the LTC and the real estate side of things.
And maybe we could just throw up a 10-year chart for Extendicare, because of course during COVID, those stocks were weak for a while. People concerned about safety in senior residences, etc. But that stock came roaring back.
Yeah, and I think what a reflection in that is the improved balance sheet over time. You've seen operating metrics and the occupancy in long-term care normalize, and then you're seeing this very strong organic growth in home healthcare that I mentioned. Putting up 10% or higher versus what's normally kind of a mid-single-digit growth business. I think that transition of getting a new investor base to look at the company as it reshapes itself. I think you're starting to see that bear fruit in the market here.
And finally, you've got a nice diverse set of ideas this for us here. Highlander Silver, what are they all about and why have they caught your attention?
Yeah, in this market environment, Andy, I'd be remiss if we weren't talking about commodity stocks here. And I think the big question for investors, you look at the price of gold, you look at the price of silver, they're at all-time highs, and you're worried, have I missed the move? But we see opportunities within the actual equities that have significantly lagged the commodity. I mean, you look in the last 6 months, for example, the price of silver is up about 150%, but the equities themselves, if you look at the Silver Miners ETF, that's only up 90%. I say only 90%, but significantly lag the commodity here. We turn to Highlander. This is a TSX silver miner developing assets in Peru. I think the first thing you want to look at with a commodity stock is the people and who's backing the company. And this is backed by some of the most successful and biggest investors in commodities, names like Eric Sprott, the Lundin family, and Augusta Group. So we have a lot of confidence in the team there, and we think that the company's in good hands. When we look at the company itself, involved in Peru, which is a good mining jurisdiction, they have two assets. Their flagship asset of San Luis, that's one of the highest grade precious metal mines in the world. And then they recently completed an acquisition of a company called Bear Creek, and they got the Corani Silver Project, which is also in Peru. That's one of the largest permitted silver projects in the world. So some really big optionality within silver, within this company. But the rub is really within the valuation. And going back to the equities lagging the commodity, Highlander Silver trades at about 30% of its net asset value. The stock's around $6. Its peers trade at about 60% of their net asset value. So that would imply that the stock could double. Now, this is all being priced off of a $40 US silver price per ounce. Silver right now is trading at closer to $90 an ounce. So, let's say put an $80 silver price on the net asset value of the company, we think there's potential to double again. So lots of torque, lots of upside in this commodity bull market that we're in. And we like the backing, we like the asset package, so we think this is a great opportunity. The other two things are the company is going to look to list on the New York Stock Exchange, and also we think it'll get included into some of these mining indexes, which will help continue to improve trading liquidity and get people more access to be able to get involved in the name.
Thank you. Thanks very much, Graham. Really appreciate it.
Thanks for having me.
Graham Kreindler, analyst at Newgen Asset Management. Coming up, we're going to tell you how streamflation is taking a bite out of family budgets. Okay, everybody is worried about the cost of living. Let's get to the cost of streaming TV. Yep, that's getting more expensive. Here's ABC's Sophie Flay.
This morning, streamflation is taking a bite out of family budgets. Paramount Plus.
You think you understand how this business works, but you don't.
Home of Landman is the latest to raise prices by another $1 per month. The premium individual plan now $13.99. Music streamer Spotify also raising prices for the third time in 3 years. Family plans jumping by $2 a month.
Our social fabric right now, psychologically, these streaming services are being seen as a utility, an indispensable thing that people will pay for every month. So it might be quite a while before people give up their grip on subscriptions, even as prices rise.
The overall cost of subscription video services jumped by nearly 20% last month alone. And prices are up an average of $7 per month since 2020. As streamers buy rights to more content, including live sports. Mega deals, including Netflix potentially buying Warner Brothers, could also put pressure on the bottom line.
Plus is actually now standard, but it is better than common. And this new tier, it is ultra premium.
The cost of content is always going up. So I don't know where it stops, but obviously it has to stop somewhere because eventually consumers will reach their limit.
So how do you fight back against the streamflation? The so-called churn strategy, subscribing to one service for a month to binge a show, then canceling and moving to the next. But it will start to cost you because most providers are no longer offering free trials, except ads. Downgrading from a premium to an ad-supported tier can slash your bill by up to 50%. And check your perks. Some credit cards, cell phone plans, and services like Walmart Plus offer discounts on streaming services. Sophie Flay, ABC News, New York.
So home sales were down in Canada last year, but some market watchers are forecasting a slight rebound in 2026 thanks to first-time buyers. CTV's Abigail Beeman has more in this report.
My father talked about his first house that he bought was $80,000, which is now my down payment.
John Gilmer is like so many millennials struggling to buy a first home.
Feels almost like spinning tires.
Even with a household income above $200,000 a year.
The target keeps getting raised as fast as our savings.
Water building up behind a dam.
The Canadian Real Estate Association says pent-up demand from first-time buyers like Gilmer and lower interest rates fuel its new growth projections. After a 1.9% drop in 2025, CREA projects national home sales will climb 5.1% in 2026 and 3.5% in 2027. Prices predicted to climb, too, to a national average just under $700,000 this year and $715,000 next year.
People in their 30s who are saying, I need something big enough to start a family in, it doesn't exist. Or it exists in the legacy detached space, which is very expensive.
The so-called missing middle of affordable options.
People aren't necessarily interested in like a condominium townhouse or a condo itself, and they're having trouble getting into like a freehold.
CREA says over the last 2 decades, there's been a switch from building low-density detached housing to building mostly apartments. John Gilmer is hopeful this will be his year to buy, thanks to savings, lower interest rates, and financial help from his parents.
My $2,700 a month that I'm paying in rent could be used in much better manner where I'm building equity.
The Prime Minister has committed to doubling the rate of home construction. CREA says it has a sense of optimism about the federal Build Canada Homes Agency, but in the medium to long term. Meanwhile, the problem of affordable housing remains pressing today.
Abigail Beeman of CTV News. Let's have a quick look at the TSX. Earlier, it was trading in record territory. It has slipped a little bit now, but maybe we can have another look at Cameco hitting a new record high today amid optimism about a nuclear build-out in the U.S. market. There's a one-year look at the stock up almost 130%. The White House, apparently, south of the border, planning to press tech companies to build their own electricity. Well, they are to build their own generating facilities. They have been doing that already, but this presumably would increase pressure on them to create extra generation capacity. So Cameco, a new record high. A couple of other stocks in favor with investors. Bank of Montreal in record territory as well. BMO topping $189. So that one in favor with investors. Franco-Nevada in record territory as well. I'm not sure if the stock is actually up today, but it did touch a record earlier, slightly down because we have seen some selling in gold today. And Sprott, I talked about this one yesterday, SII. I am guessing this one is hitting a record high today because, of course, anytime you see optimism in uranium, that tends to be good for Sprott, which had a major effect quite a few years ago when it launched that uranium exchange traded fund. And sure enough, my screen is showing a record high for Sprott today. Let's have a quick look at the U.S. markets. The S&P 500 down a little bit. It briefly got its snout above 7,000 yesterday to trade in record territory, but it is down from that level. And this is interesting. Mosaic, the big fertilizer maker, under pressure. We have seen more optimism about the potash market, and Mosaic is a player there. However, its fourth quarter results pointing to a significant decline in North American fertilizer demand in the fourth quarter of last year. And we have seen some selling this morning in the likes of Nutrien and CF Industries. Constellation Energy. Oh, that's interesting as well. This is one of these U.S. generating companies that has had a magnificent run because of optimism over more power demand, but Constellation Energy down. I'm not seeing why it would be down. Okay. Yeah, apparently, this reported push for tech firms to pay for new power plants, this administration push, apparently that's not delighting investors. Maybe they just are worried about more competition in the electrical market. Thanks very much indeed for watching. The Open Morning Markets is up next.